welcome everyone. It's delighted to have you with us this morning, even if Congress did not produce as much legislation to talk about as I guess perhaps we were hoping when we scheduled this. But I think there are still some things that are worthwhile our taking a look at, both with respect to legislation that could still come, as well as picking up on the implementation of legislation that has come in the past. And Andrea Mao is with us today to cover a particular piece that carries over from actually from 2017. So, you know, it takes Congress, it takes the IRS a while sometimes to catch up, particularly when Congress is not as detailed as they should be. Let's start let's start now with here's our brief summary of the agenda, and let's start with where we are. And of course, where we are is where we have been now for quite a while, in a very, very partisan sense of the situation here in Washington, D.C. Not a lot of opportunity for bipartisanship. And frankly, things have been made somewhat worse with result of the situation. Now, we do have a continuing resolution that is moving forward for appropriations purposes. This essentially means that the one bipartisan thing they have agreed on is they do not want a government shutdown to take place here at the end of September when the government's fiscal year comes to an end. Now, the legislation passed the House this week. It is expected to pass in the Senate. Some question as to why it is being held for the time being. There's a possibility that some additional items could be added, but there does appear to be an agreement that if anything else is added, it will be added only if there is bipartisan agreement between both the Senate and the House, so that the House can accept whatever the Senate sends over to it. With respect to COVID-19 relief legislation, which many of us have been looking for, it does appear that at this point negotiations have failed. And so consequently, whether we will see additional relief probably now depends upon how the economic and political situation develops post-election. With the connection, we mentioned the Supreme Court situation. Trump is expected to announce his nominee. It looks like now Saturday is probably the most likely day. The Senate Judiciary Committee will move quickly to pass it to the full Senate, almost certainly on a strictly partisan basis, and then the vote could be taken up as early as the end of next week. We will see how that develops, but that one appears to be pretty much in the pretty much taken care of. Now, whether that will prevent any further discussions, any further bipartisan movement, which is probably what is required now, is unclear. It certainly has added to the partisan atmosphere here, and I think, frankly, is making any kind of legislation between now and adjournment much less likely. In terms of when adjournment may occur, I think most observers are now looking at Columbus Day as the likely effective adjournment day, even if both the House and the Senate remain in pro forma session. We expect that members will, by and large, be home in their states and districts once Columbus Day comes and is gone. Now, this does, of course, raise the question of what's going to be happening next. What's going to be happening for the rest of the year? It is the lame duck is almost certain to take place. Who knows? It's difficult to say with respect to Congress that anything is a certainty. But with the continuing resolution only taking us through December 11th, they almost certainly now have to return in order to at least pass an additional continuing resolution. Whether this could result in an omnibus reconciliation that would finalize spending for the fiscal year, which of course is beginning in a week, I would say probably is doubtful. But I think also the idea of a government shutdown is doubtful. Although again, those are the three alternatives, and it's best not to say definitively that this is what Congress must do. If I were to bet, I would bet on an additional continuing resolution that takes us until sometime either in the late winter or early spring. That seems to be what we're seeing from the talking heads from the various investment houses, but that is, of course, their opinion, and it is not a certainty. Will we come back to see additional COVID-19 relief legislation? This seems, I think that there is a good chance that we will see this. It clearly depends upon the economic situation that we face at the time that the lame duck Congress returns. If we see a continued deterioration of the economy, or at least no additional progress in getting everyone back to work, then I think the chances that we will see additional COVID legislation substantially go up. What items are likely to be included is essentially it's the items that pretty much are agreed to right now. There is not agreement with respect to the size of the package, and that could always be a limitation on their completing the consideration. But I would look to these items, particularly the PPP loan program. An additional round of that seems to be very, very popular, as well as the question of what you do with the expenses that you pay with the proceeds of a forgiven PPP loan, which the Internal Revenues has said that, well, under current law, those clearly are not deductible. Congress, I think, was surprised when that result came. Probably shouldn't have been, but was surprised. And if we do see COVID-19 legislation, the feeling still seems to be that there is a high likelihood that that will take place. Some question, some of the advanced thinkers, I believe, are already considering whether or not you might want to defer having your loan forgiveness applied for until after the first of the year, which would then cast everything into 2021, providing additional time for Congress to respond to this. Let's see what happens in late November and December in the lame duck before we move forward with any of that. But let's say, as optimistic as some of us may be that we will get back to COVID-19 legislation if the situation demands it, the place will not be that different than how they are leaving it to go for the election. And there is always the possibility that the partisan nature of things here will stand in the way of anything being accomplished. As I mentioned at the beginning, in addition to pending legislation, we also wanted to talk today about the implementation of previous legislation. And to kick that off, I am going to turn the program over to Andrea, who will lead us through some of the most recent guidance that the IRS has finally produced with respect to bonus depreciation, and even perhaps some thoughts on some additional guidance that we may need going forward. Yes. So Andrea, please have at it.
Perfect. Thank you, Mel. Well, earlier this week, we received a set of final regulations from the IRS related to the 100% bonus depreciation provisions that were enacted as part of the TCJA, as Mel referenced. Some of you may be thinking, wait, didn't we already get this? And the answer is, well, kinda. This is now the fourth package of guidance we have received on the bonus depreciation rules. We had proposed regs in 2018. Last year we had a set of final regs, and we had a new set of proposed regs. And so these final regs are largely focused on the issues that were identified in last year's, in the 2019 proposed regs. And these supplement the final regulations that we received last year. So getting all our ducks in a row here, we think this is likely to be at least the IRS views this as the end of their current regulation project under the statute, with some procedural guidance we'll talk about in a second. But unfortunately, there is still some items, or are still some items that are open, and taxpayers have already started to raise questions on these final regulations. So we may see more in the future, but for now, we're tentatively referring to these as the final regulations under 168K, for what that's worth. And as I said, most of the focus of this particular package is on the issues that were raised, many for the first time in the proposed regulations issued last year. Some of them focused on the used property eligibility. Recall that prior to the TCJA, property was eligible for bonus depreciation, but generally had to be original use or new property. The TCJA introduced the concept of allowing used property to be eligible for bonus, which raised a host of questions to avoid anti-churning and transactions intended just to generate bonus depreciation deductions. And so what we've seen are some relatively complicated rules in some cases regarding related party and consolidated group transactions. Who can qualify for bonus? Who gets the bonus? When does the bonus come into play? How do we decide who's related? When are these determinations made? And in addition, in order to qualify for the 100% bonus, the assets needed to be both acquired and placed in service after September 27, 2017. So lots of questions were raised about, well, can I move this acquisition from before to after? What does it really mean to be acquired? And so we did get some additional clarity on those rules with respect to property that is constructed by a third party under a contract, as well as property that is acquired under a contract that is not binding at the time it is entered. Right now, we are expecting the IRS is going to provide us with some procedural rules to help us implement these regulations, because some of the provisions in these final regulations are different than what was in prior versions of proposed regulations, and in many cases may be different than what taxpayers have done on their prior year returns. That guidance is currently in the clearance process, according to our contacts at the Internal Revenue Service. However, we still expect that that's probably a week or two out at best. So we may see that before the October 15th filing deadline, but for most people, we would anticipate this is going to be a 2020 issue. And what we would recommend right now is that people, and if you had assets that were placed in service in 17 and 18 and even 19 in some cases, to go back and reassess, okay, did I take 100% bonus? If I didn't, can I now qualify? Because some of these rules have been more taxpayer favorable than anticipated. Or if I did take 100% bonus, was I really eligible to? Some of the provisions here provided certainty around definitions that there was uncertainty around in the past. So we'd recommend that you reevaluate the assets that you've placed in service just to confirm that we're taking the proper percentage of bonus. Generally speaking, these regulations are required to be applied to assets placed in service on or after January 1, 2021, but taxpayers do have the option to apply these to earlier tax years as long as they're applied consistently and applied for all subsequent years. So if you choose to apply these final regs to the 2018 return, you're stuck applying these to 2019 and 2020 as well. You can't implement these and then go back to the old rules and then go back to these. Once you've crossed the bridge to use these rules, those will be the rules that will be used. And to Mel's comment regarding additional regulations, there are a number of provisions of the TCJA on which we have not received final guidance, some in the space of revenue recognition, some small taxpayer rules, some of the international rules, I believe we're still waiting on some final rules for. And the internal goal of Treasury, they have been informing us, is that all of those regulations are intended to be issued by the end of the calendar year, which would certainly be a daunting task. And I've even heard more recently that that deadline is now getting pushed up, possibly into October. So we are likely to see things start to move a little bit faster than they have been historically in this space, which is good news and bad news. You know, rules are helpful, but unfortunately, when they don't get adequate consideration, we can end up with some results that are not taxpayer favorable, which just increases the likelihood that we're going to need to revisit these in the future. I don't know, Mel, have you heard anything through your channels on this?
There is great, I think the term that I would use is terror on the part of attorneys at the Treasury and in the Chief Counsel's Office of the Internal Revenue Service that, in fact, someone would issue what they believe is probably a pre-first draft of some of these regulations. There was a question that came in regarding, now, are you going to talk about some of the open issues with respect to the foreign treatment, guilty, those things? No, we're not going to talk about that at all. That requires about a 3-hour session, all separate, and is not necessarily the primary role of either Andrea or myself. But
Yep.
rest assured that we will have additional webcasts in excruciating detail available as these additional provisions come out, which you can choose to attend or not attend
Or not.
as the as one, your need for the information may be, as well as your tolerance for listening to the information. And with that, because that quietly eliminated, I think, or I hope, any additional need to talk about what we have not yet gotten in guidance from 2017, we can move forward now and talk a little bit. Here, I'm going to click here and see if this, there we go, about some guidance from 2019 that recently popped out. Notice 2020-68. Provided some Q&As with respect to provisions that had come in the Secure Act. Now, for those of us who sort of put the Secure Act aside and have not thought about it in a while, this was legislation that was included in the omnibus bill at the end of December of last year, which primarily dealt with an expansion of access to tax-favored retirement arrangements, IRAs, things of that nature. This is what allows contributions to be made into an IRA by people regardless of their age. This is what created some special rules with respect to how you have to distribute the proceeds of a IRA that is inherited in certain circumstances, as well as a new provision that is not actually to be applicable until sometime well in the future, that would at some point bring part-time, at least some part-time employees into the company-based retirement system. A number of issues are addressed within Notice 20-2068. Just wanted to focus on a few of the key ones. As I mentioned, one of the provisions in the Secure Act was to allow contributions to an IRA to be made without regard to age. Previously, once you reach the 70.5 age, you could not make a further contribution into your IRA. One of the things that I think did not receive as much attention was how this interacts with the special rules that allow for contributions, qualified contributions to charities, to be made out of an IRA essentially as a wash. You don't treat it as taxable income distributed out. You do not take a charitable deduction. But if you have, well, for various reasons, this can be a highly preferential approach to be taken. There is, however, an intersection that, again, I think did not receive a tremendous amount of attention. And that is, if you contribute to an IRA post age 70.5, that amount has to be essentially recovered before you can take the beneficial qualified charitable distribution. So for instance, let's say we have a taxpayer that has reached age 75. They contribute $5,000 to their IRA this year based on whatever, normal rules that would allow that. If they then turn around and make a $7,000, their required annual distribution, let's say, is $7,000. They take that, and instead of taking it in cash, they make it as a contribution, let's say to the Red Cross. Okay. Normally, we would say, well, you can't put the 5 in. Previously, we would have said you can't put the 5 in. You take the 7 out, the 7 qualifies. Well, because of the interaction now, you put the 5 in. That's a deduction. But the first $5,000 cannot be treated as a qualified charitable distribution from the IRA. You have to catch up. Now, the combination is still somewhat more beneficial to taxpayers than was the original situation, but it is a limitation that I think was not particularly focused on by by people, and certainly by people that were discussing the Secure Act as it came through. Also, the ability to contribute to the IRA post age 70 and a half is a separate transaction. The contribution itself is a separate transaction from the required minimum distribution. Now, keep in mind, we don't have a required minimum distribution in 2020 because of the previous COVID-19 legislation, but that is expected to be back in 2021. So you have to treat it as 2 separate transactions, even if it's for the same amount, and even if it is done on the same day. You don't just net them. And assuming here is that the IRS could not quite track the situation. It will be easier for them if they have 2 transactions to look at. And so the notice says, do it as 2 transactions. Now, this does create the possibility that we could make the contribution on the first day of the year and then take the required distribution at the absolute last time, thereby providing some additional funds within the tax-deferred IRA for a period. Now, for those of you young folks who are used to the idea of interest rates paying 1-2%, this probably is not a big deal. For those of us who are older, who remember when you could get 15% on a CD, there is an instinct to try and take advantage of the time value of money. And since that does describe the crew that is probably in the 70 and a half group, I would keep that. With respect to part-timers, there is a question there. It's a fairly detailed question, but you have to have been a qualified part-time employee, essentially work 500 hours or more for 3 consecutive years, and years beginning before 2021 don't count. So effectively, 2024 is the first year that you might be required to bring a part-time employee into, for instance, let's say the company's 401k. But that effective date only applied to when you have to let them in. If in fact they have met the 500 plus hours in 20, 21, 22, 23, you have to count all of those years for vesting purposes. And this is a little bit different twist, and I think was a surprise to some people who spend their lives trying to design their way or to design these types of programs. Finally, excuse me, I will mention that a provision in the Secure Act did allow for tax-free distributions up to $5,000 per person for expenses associated with qualified birth or adoption. There is a long list of Q&As in the notice that covers these. Key items are you can apply this to more than one child, and you can apply this to more than one parent, particularly if you have a situation where the parents are filing separate returns. I will, if you are clearly, if you have a client that is involved in this, if you are personally or a family member is involved in this, we congratulate you on taking the step to taking this step. We congratulate you on the birth and refer you to the notice for a full consideration of the Q&As. And that brings us to the current year. And the PPP loan we mentioned before, some question has come as to who has to report what with respect to forgiveness of the PPP loan. Announcement 2020-12 came out this week and said, and you can see the quote here on the screen, lenders should not file information returns or furnish payee statements. If you do this, you are likely to trigger a letter from the IRS, which is neither necessary, is not required, and probably causes more trouble than it's worth. At the moment, it appears that no one is specifically reporting that this takes place, other than possibly not claiming a deduction with respect to expenses that are paid with the forgiven loan funds. I would expect that we will see some additional information coming out. It's hard to believe that small business or the IRS ultimately will want no information. But at least as it stands now, the banks, who are the nominal managers of this whole process, have been told, do not report to the IRS, do not send something specifically to the investor. One of the other questions that has come in is, what about this employee Social Security tax deferral that the president promoted within a memorandum that he issued at the end of August, and which has now been, at least some guidance has been offered under notice 2020-65. Essentially, key thing to keep in mind with respect to this is that the implementation of this is taking place under 7508A. And what that does is allow the IRS, allow the commissioner to disregard whether an act has been timely performed. And what notice 2020-65 comes out and says is, okay, we are going to disregard the withholding of Social Security, of the employee share of Social Security taxes. We will disregard the timing of that. Now, that didn't say that we're going to disregard the deposit, but the deposit is controlled by the withholding. So if you don't withhold, you participate in the program, then there is not a current requirement to deposit. If you do choose to withhold, then the deposit requirement remains in place, and you need to go ahead and send the money in on the same basis, either quarterly or per depending on the size of your deposits, where that is. What is the scope of the deferral? It's, as I said, it's the employee share of Social Security taxes. If you have railroad retirement taxes, it's the equivalent amount. It does not cover Medicare taxes. It does not cover the employer's share of Social Security taxes. Keep in mind that the employer's share could be deferred under provisions that we saw back in the earlier COVID-19 legislation. And it applies to compensation that is paid on a pay date between September 1 of 2020 through December 31 of 2020. And it is the date of payment that controls. Does not matter when it was earned, it is when it is paid. So if you pay August on September the 2nd, then the Social Security, employee Social Security taxes with respect to that payment is eligible for consideration. Similarly, if you pay December on January 2nd, that will not fall within the limited pay date period. and would not be eligible for the deferral. Um, Now, again, coming back, because this was done under the authority of 7508A, so this is what we typically have used for things like hurricanes, direct shows, tornadoes. Uh, no one, it's not a requirement. It doesn't say, it says you can disregard. It doesn't say you have to disregard. So it really is the employer's choice to participate or not. We don't see any real restrictions on the ability of the employer to pick and choose. So if you did not begin to participate with regard to the first payment on or after September 1st, you can still begin participation later. You don't have to you don't have to make it an all or nothing participation situation. So there are some employers who have stated that they intend to allow the deferral for those employees who would like to defer and will not for others. Other employers have said, no, we're not going to go through the difficulty of that. Either everybody's in or everybody's out, but it is the employer's choice as to whether or not this takes place. One caveat, obviously, be careful if you allow some people in, but you don't allow everyone in, and it looks like you have discriminated between groups. Make sure that that discrimination is not going to run afoul of some provision in your state's or even the federal employment laws. How does this work? Well, you defer during the period, and then the idea is it has to be paid back. It's a deferral. It's not a forgiveness. Has to be paid back. The assumption seems to be that it will be paid back by additional withholding from the employee's paycheck during the first 4 months of 2021, which matches up with the the last 4 months of 2020 when we did not withhold. And no interest and penalties are to accrue before May the 1st of 2021. The employer, by the way, is the one who's responsible for doing all this. And so if your employee disappears and you have not made other arrangements, you, the employer, are on the hook for paying this. Now, there is an anticipation that alternative arrangements can be made. There is an anticipation that, in fact, alternative arrangements could be made that would backload the payment so long as it is done, repayment, so long as it is done by April 30th. But that is that's up to you. Also, again, here is an area where you want to be careful as the employer that you do not run afoul of any particularly state employment statutes that might apply to a situation where you are trying to recover, perhaps out of wages or out of future wages, amounts that need to be paid back. And this is something that's got to be looked at, I believe, on a state-by-state basis. And we're simply going to have to refer you to to your state attorneys with respect to that, because the bar associations remind me that I am not licensed to practice law. Now, as always, there are reporting requirements. We've seen the draft Form 941. That appears to be very, very close to be finalized. They're going to ask you for the total amount of deferred Social Security taxes. That's going to go on line 13B of the new one, and that is, if you read the instructions, the draft instructions, that includes both the employer and employee's deferred share. And then you give them the information that they need to break it out by putting the employee share only down on line 24. This is different than what we were looking at before, where line 13 was only for the employer. So be aware at least that this is, we will clearly need some 941X's to handle some changes. And the W-2, how we're going to handle this on the W-2 is something of a mystery still, but we're looking forward. Now, why do this? And I've got to say, most of the clients that our group, our business operations group represents, at least for the time being, have decided not to participate in the deferral scheme. But we did want to do a little bit of back of the envelope calculation and take a look at what really is the maximum benefit based on a time value of money. And we've imputed a pretty healthy interest rate here for the time value of money. But assuming repayment is required and that it takes place ratably over the first 4 months of 2021. And we came out with a maximum benefit, because this, remember, only applies to wages of $4,000 per biweekly period, maximum potential benefit to the employee of about $75 in time value of money. Now, obviously, if the deferred amount is forgiven, that is a very, very different question. And we're going to skip, let's not get to the polling question right now. Legislation has been introduced in the House of Representatives by the ranking Republican member of the Ways and Means Committee that would forgive the deferred amounts, but also would forgive the amounts that could have been deferred. And many observers here in Washington feel that the more likely result is that if there is going to be forgiveness, then the forgiveness will apply to everyone within the context of the $4,000 per biweekly period, which works out to about $107,000 annual if you don't build in things like bonus and commissions. But that would be a pretty expensive item and clearly would need to be part of an additional COVID-19 legislation, which some people think is we may see in lame duck, we may not see in lame duck. So it's always very, very risky to try and guess exactly what Congress is going to do. But there does seem to be some sense that if there is forgiveness, it will not just be limited to those who have, whose employer has chosen to participate in the deferral scheme. On the other hand, there are employers who are concerned about that exact thing happening and are willing to take the extra steps and participate in the scheme, just to make sure that they do not get caught by a piece of legislation that would defer or that would forgive only the deferred amount and not the Social Security taxes that were eligible to be deferred. As I say, the existing legislation, the only piece of existing legislation we see would cover both deferred and deferrable. But who knows what the final item would be. So with that, I'm going to take us to polling question number 3. And Amy, why don't you read them out for us?
All right, so polling question number 3 here. Does your business intend to implement employee Social Security tax deferral?
And as we have seen with the other client, I guess many of you are on the webcast with us today. No, we don't plan to implement. Does seem to be, and I think that raises that does play into how that ultimately plays out. I think does play into the question of whether or not we're going to see forgiveness. If there are very few employers who do participate, the federal government has announced that they are participating, although the House of Representatives has said that they are not. On one hand, it makes it less expensive in terms of revenue loss to the Treasury if you only forgive that limited group. but also it creates a situation where it really does look like you are favoring a limited group that just happened to work for the right employer who guessed right with respect to this. And I think that will be a difficult vote for many members of Congress to take. But again, we're getting into the speculative area here. And with that, we're going to move into the truly speculative area and talk a little bit for the rest of the time that we have today for what the outlook for 2021 and beyond is going to be. And let's be frank, what is going to happen tax-wise in 2021 and beyond is very, very much dependent upon what is going to happen in the election. And it is been suggested by many that this is more of a question of the approval of the current president versus a choice between the current president and his opponent. So we focus here on the relative approval and non-approval trends that we see reflected. And this is a study that is done by some people at Certus Insights, and it is an average of a number of polls that are taken. They do not take the poll themselves. It is an average of polls that are taken. And interestingly enough, they calculate both a full average, and they also calculate an average that excludes the two extremes. And generally, they have come up with the same number using both approaches. And as you can see from the graph, this is the president has been in the red for the entirety of 2020, but that gap has been closing here of late. These numbers do not fully reflect any kickback or result from the Supreme Court situation. Expectation is that it will likely increase both numbers, but there does seem to be a sense that that may result in a further narrowing. Keep in mind also that this is a national average and does not attempt to reflect what the issue would be on a state-by-state basis or to translate that into electoral votes. And that is the election is based, the winner is based on the collection of 270 electoral votes. It is not based on who gets the most votes in total. Let's say that the Republicans, let's say that Trump holds on. Things that I would look for going forward as priorities are, first of all, make the 2017 TCJA Tax Cut and Jobs Act cuts permanent. The individual tax brackets that were scheduled to expire after 10 years. The increased death tax exclusion. Bonus depreciation that Andrea talked about but is scheduled to phase out. And the going away of the pass-through deduction, the Section 199A. Those are four things that certainly I would look to, but I think that the entirety, anything that expired under TCJA, or for that matter, springs into action later on, such as the requirement that research costs be amortized, does not take effect for a number of years. I would expect that either to be kicked farther out into the future or to be eliminated entirely. With regard to TCJA, there probably are modifications that would be sought with respect to the international provisions to make them more focused on an America First approach, as well as to combat the OECD initiatives that are pushing for more of a global measurement of taxable income and a restricted view on who is able to tax which income. I would also expect there to see increased overall investment incentives. We'll talk about some targeted investment incentives on the Democratic side. There has been discussion of reducing capital gains taxes, either by reducing the 20% rate, maybe just down to 15 for everyone, or even for indexing capital gains. And while that may be too big a push if the indexing is allowed to be retroactive to earlier years, given the current state of inflation, prospective indexing might well be something that could be pushed forward in a context where the Republicans could primarily call the shots. And savings is good, and expanded savings opportunities for that. With regard to social issues, I think that is likely to be less of a tax initiative with respect to the Republicans, but certainly making things that currently support public education available to private education is expected to be part of that. Now, on the other hand, let's say the Democrats come out ahead. If that is the case, then I think a lot of the things we see are in reverse. Reining in or even reversing the TCJA tax cuts. There's been Biden's program has called for increasing the corporate rate up to 28%. There is scuttlebutt that, maybe 25 would do, but that's scuttlebutt and not necessarily the published provision. The focus with respect to the increases in the individual side, at this point, Biden has set out a $400,000 per year taxable income trigger amount. And so we would be looking under a Democratic regime at potentially higher individual rates on those above 400,000. There's been talk about further reducing the charitable deduction, or further reducing itemized deductions for high-income taxpayers, eliminating the 199A pass-through deduction for high-income taxpayers, and maybe even taking the estate tax exemption back down to where it was scheduled to be before the TCJA tax cuts took effect. Perhaps more drastic changes with respect to truly high income. Well, what would be, let's define as truly high income, which is pretty much, if you got $1 million taxable for the year, you are truly high income. And there we could be looking at the potential of a surtax, maybe a revised minimum tax that would sweep in as preferences things like the capital gains exclusion, and also specifically reducing the benefit of specific tax preferences, some of which are currently picked up by the current alternative minimum tax, others of which are not. This is an item again where I think there is not a clear path forward, other than there is some concern that people who make more than $1 million should be paying more tax. Now, the idea of incentivizing behavior, we talked about incentivizing savings on the Republican side, perhaps more targeted incentives on the Democratic side. Expanded alternative energy credits are something certainly we would look for. Expanded low-income housing incentives, as well as probably an expansion in the child care area. Now, as you think about all this, I would reference the title. This should be viewed primarily as initiatives to raise revenue to spend on something else. Republicans have a view that taxes need to be lowered, and that is the driving thought at least for the current Republican Party, as to how taxes should be approached. The Democrats, on the other hand, are less engaged with taxes as taxes, much more engaged with the idea of taxes as tools. Here's how we raise the revenue to pay for something else. I would also mention here in the context, if we do see a Democratic regime, the current international regime that was created in the TCJA had some Democratic input, but is very poorly understood by Democrats, probably more than Republicans who had a closer connection with its creation. There does seem to be some sense that the Democrats would like to take their own shot at it. And so if we do see a Democratic regime, complete reconsideration, or at least extensive reconsideration of the international changes is likely to be on the table. Now, that does not mean that we would expect to go back to the traditional tax worldwide income and then provide a foreign tax credit. I think we are beyond that. It was well recognized that what that was doing was creating a situation where U.S. multinationals were at a competitive disadvantage to other nations' multinationals. But how that is implemented, what sort of protections you put in, is it enough to raise the guilty? Do you need to expand the guilty? These are all things that could be part of a democratic international redo. Here are some items that Biden has specifically mentioned. Again, it is all done within the context of the basic change in approach that was included in TCJA, but at least at this point is designed to beef up some of the penalties and also to provide more America First onshoring type of incentives. We got a few minutes left here. I would like to now bring in, we've talked about, I think, some positive things, some potential for changes. Even when we looked at taxes, we looked at additional tax cuts on the Republican side. If there are tax increases on the Democratic side, probably things that were intended primarily to pay for additional spending. At some point, there does, however, need to be consideration of where all this leads us in the future. The Congressional Budget Office this week released their annual report on the long-term budget outlook. And it's a long document, but it's got lots of nice charts. Go to the CBO.gov. And I would, if you're interested in this kind of thing and how legislation moves forward, what its effect on the economy can be, I would urge you to take a look at this. What it is clearly pointing out, and I apologize, we have a little problem here with our pictures being in the way, is that we're now talking about a historic amount of a historic percentage of gross domestic product being represented in publicly held debt. This doesn't include the debt that is being sopped up by the Fed. This is held by the public. And the current projection, it takes us out, 2040 is the far right point here, to an area that is almost 200% of the annual gross domestic product, which previously is what we would have compared to, say, Italy or Greece, and is double the situation that we saw at the height of World War II. And we had not approached that really until we hit the pandemic, the spending with respect to COVID-19 in the pandemic, as necessary as it may have been, and where that leads us. And as you can see here, this assumes that we continue spending at its current scheduled rate. COVID-19 does not have scheduled spending really beyond 2020. Yet the outlays are exceeding revenues by a growing amount. And why is that? It's because we're having to pay more and more interest on the funds that are out there, going from 8% last year, which is their real number, to an estimate by the time we get to 2050 of 26%. Right now, we have an extremely low interest rate. There is a lot to be said for the idea that you have this is a golden opportunity to borrow, spend, and invest. And there is much to be said for that. On the other hand, let's not lose sight of the fact that that money does attract, even if you don't pay it back, you still have to pay interest on it. And at the current rates, and the CBO is not anticipating extremely high interest rates when it applies these calculations, but we still see more than a trebling of the percentage of federal outlays that will have to go to interest as we go forward in the future. And this, again, is very much a change that we see reflected this year. The light purple number you see is the number from this time last year. And then with 1 year's change, we go to the dark purple. Primary deficit does not include interest. Total deficit does include interest. And it is an issue. At some point, this is ultimately, I believe, going to have to be taken into account as we move forward with determining not just what our spending programs are going to be, but also what our tax programs are going to be. And here you can see again the increase in the expectation of federal debt being held out there, just in the change in estimate from 2019 to 2020 on the part of this Congressional Budget Office. And I want to thank I know we've maybe run a couple of minutes over here. I apologize for that. I know everybody's time is valuable. But thank you very much for joining us, and look forward to talking with you all again, probably after the election when we can refine some of these guesses.